Today we're talking about whether a foreclosure crisis is looming for the Denver market. Thank you to each of you who watched last month's video on the troubles in the Denver market, and an extra special thank you to those of you who left comments, shared your thoughts, sent me notes and texts, and gave me calls about it. I do appreciate it so much. And I knew going into the video that I wasn't going to give a lot of attention to foreclosure, and that was for a reason. But my lack of attention to it was pointed out and people asked a lot of questions, so we got to talk about it. By the way, if you haven't seen last month's video and you want to play catch up, you can look at it right here, and then I'll link to this video at the end so you can come right back to it. For my friends who watch regularly, good to see you. Welcome back. For those of you who are new, I am Alyson Wahl. I'm a real estate strategist and realtor here in the South Denver area. And I'm just gonna say it right up front, in no way do I believe that Denver or the nation as a whole is headed for a foreclosure crisis. Do I think that foreclosures are going to increase over where they've been? Heck, we've been in a moratorium, so they're at almost zero. Do I think they're gonna be above where they've been for the last couple of years? Yes, I do. But do I think they're going to hit a level worthy of the word crisis? No, I don't. I'm a little bit tired. Actually, I'm a lot tired of the fear-mongering. The market's gonna crash. We're gonna be in a foreclosure crisis. Everything is doomsday. We don't need any more of that on top of what we're all going through with the coronavirus pandemic. A foreclosure is a crisis to the family that is involved, most certainly. But let's be clear. What's being bantered about online, in the media, is that this forthcoming housing crash that people are forecasting for 2021 is in part going to be brought on by the foreclosure crisis that is going to start by millions of Americans across every income bracket in every city foreclosing on their homes, putting downward pressure on home prices, then cyclically causing other homeowners to be inverted in their home value, essentially being upside down, which then triggers a foreclosure crisis. People tend to stop paying on their homes when they're upside down. I don't see that happening. But let's talk in more detail. For those of you that know me, that means we're gonna dig into some numbers. I heard a great podcast the other day by The Daily from the New York Times. It broke down our economy into 7 basic numbers. I'm gonna rehash those numbers here with you, at least some of them, because they bring to our attention some topics that can be a little bit difficult to address in the middle of the conversation. The first economic number, 10 million. That's where we are in our employment gap. So we lost a whole bunch of jobs early on in COVID. We have rebounded quite a lot of those, but not all of them. So we still have a gap of 10 million jobs. As a reference point, there were 8.7 million jobs lost during the Great Recession. The second economic number, 7.2%. That's the growth in spending on consumer goods from January to September of this year. That has been on a trajectory that is higher and faster than we were even pre-pandemic. Makes sense, right? We're not spending on other things. We're home, we need more stuff, so we're spending on a lot more items. Third economic number, 7%. The average increase in home prices in the last year. We have talked a lot about that if you've been watching the market updates. The host and the guest of the podcast share these thoughts as well. This has been a pandemic that has fundamentally affected wealthier and less wealthy people in very, very different ways. So the housing market is a perfect example of that. If you were a white-collar professional during this, there's a pretty good chance that you held on to your job. You can get a loan, and therefore you can take advantage of these really good interest rates to go and buy a house that maybe will bring you wealth over time. So this wealth gap component that they talk about is important for us to touch on. And sadly, it is very real. It also plays a part in why I do not think we are headed for a blanket nationwide, every city foreclosure crisis. The homes I've sold this year to remote workers who are software engineers who've been steadily employed with their companies for 5, 7, 9 years, and they've decided to move with the blessing of their company to a different location where they get better cost of living, maybe a better quality of life, are at low to no risk of foreclosure. And I have numerous clients like this, And my clients are a microcosm of what is happening all over the country. Financially sound buyers, often with 2 income streams, are moving from one area to another one with equal or lower cost of living and trading their exorbitant rent or their very high housing costs for something more manageable, a stable mortgage, and enjoying historically low interest rates. On top of that, here in Denver, median home values have grown about $40,000 just in the last 6 months. So homeowners just this year who have purchased are gaining equity hand over fist, as long as they're not touching that home equity with a HELOC, of course. These are hardly the makings of a foreclosure crisis, even if some of these homeowners put only 3% down on their home. Okay, the fourth economic number, negative 6.1%. This was the decline in spending on services from January to September of this year. Think restaurants, hotel and travel, concerts and shows, haircuts, all those things we aren't going out, getting face-to-face in large groups, those kinds of things. The service sector has fallen harder and is rebounding slower based on the realities, love it or hate it, of our pandemic life. The host and guest of the daily podcast had this commentary to say about this, which, like the commentary above, brings us into a discussion that is relevant to the foreclosure discussion. The host says, to put what you said into perspective, how big is the service economy in the US? And how responsible is something like that 6.1% decline in consumer spending on services from January to September for the number of jobs we haven't gained back? The guest answers. So of that 10 million jobs we're still in the hole relative to before the pandemic, 9 million of that is in the service sector. The host replies, so fundamentally, this recession is a service sector recession. So why is this important? 2 reasons. Data shows us over and over and over again that service sector employees earn toward the bottom of the earnings scale. And number 2, we know that this pandemic has disproportionately affected lower income wage earners. So where is this taking us in the foreclosure discussion? Well, what is the rate of home ownership by income bracket? Households in the bottom 20% of income have a home ownership rate of just 30%, while households in the top 20% of income have a home ownership rate 85% and above. So there may be a crisis of foreclosure among lower wage earners. I don't want to diminish the possibility that that can occur. These are the people who've been hardest hit by the pandemic. But as we look at home ownership by income bracket and by who owns the most volume of homes nationwide, by city, across the country, if we're looking at the people who've been hardest hit, who have the most risk of going into foreclosure, we're looking at a small segment within a small segment. This is hardly the makings of a foreclosure crisis that's going to roll from coast to coast and take down major cities and crush housing prices everywhere. If you'd like to hear numbers 5, 6, and 7 from this podcast, I will add a link in the description box below. So let's dish on Denver a little bit more. Statista just ranked the unemployment numbers by metro area with the latest data. And out of the top 25 cities, Denver ranked 22. And it was far, far behind the top 5 cities, which were Las Vegas, New Orleans, LA, the New York metro area, and the Memphis metro area. And then if we go a layer deeper and look nationwide at major metro areas affected primarily by service sector job losses like hospitality and tourism, we see Denver didn't make the top list there either. This data by MoneyGeek tells us these were the top cities: New York, LA, San Francisco, Miami, Orlando, Vegas, Atlantic City, New Orleans, and a couple of the major cities in Hawaii. All right, let's discuss another F word: forbearance. One of the arguments about why foreclosure is imminent is there are so many homeowners in forbearance, and if you're in forbearance, it's equal to foreclosure and you're doomed. Well, the story doesn't really bear out. The Mortgage Bankers Association reports that fewer than 6% of its conventional loans are in forbearance. That's fewer than 3 million homes across the US. And then let's look at data specific to Colorado. This data is the most recent that we have right now. There are just over 90,000 homes that have elected to be in forbearance in Colorado. That's less than 9%. Just over 4,500 of these are delinquent in their forbearance payments. So what does that amount to? Is that a large amount? Are we looking at a huge number of homes that are going to head into foreclosure? What does that really mean? 4,500 homes is just over 0.25% of all the homes in Colorado. So what happens if they were to all get foreclosed on at the same time and hit the market in like the same month? Well, really almost nothing. It would be like a blip on the screen for us. We have such little inventory that adding 4,500 homes in a month would just over double our inventory. We would go from roughly 3 weeks of inventory to about 6 to maybe 7 weeks of inventory, and it would really feel like a dream. I think more buyers would actually come out of the woodwork because we have so many deflated and defeated buyers who are wishing they had a chance at a home. We are seeing 10, 15, 20 offers on properties. It would be able to spread out the number of offers across these homes. But do you know what a balanced market is? 4 to 6 months of inventory. We're talking that this might move us to 6 weeks of inventory. We would still be in a strong seller's market. So these forbearance numbers are not the story of us heading to a foreclosure crisis and the market falling to pieces. So what's your takeaway? I've shared mine with you, one that is hotly contested and one that's strongly supported, depends on who you read. I would love to hear what you think. And if you want to hear the December market update, stay tuned. There were 4,300 closings in November, up 23% from the year before, and they were strongly fueled by the condo and townhome market because, well, single-family home sellers don't want to sell. They're staying put. There were 3,500 new listings, up only 4% from the year before, and almost all of that growth was also fueled by the condo and townhome market. Under contracts for November hit 4,600. That was a 19% increase over November of last year. Days on market. This is the marker of how hot the market is. It dropped another day from the previous month, down to 21 days for the average days on market. Last November of 2019, it was 34 days for an average days on market. The median days on market for suburbs like Westminster, Highlands Ranch is 4. So if the house goes on the market on Wednesday, it's gone by the weekend. That is so true. For those buyers who are writing an offer, if they and their agent are not in the house pretty much on day one and have that offer turned in really quick, then almost all hopes are lost of their offer being included in the stack of offers to be considered a couple of days later. Inventory. So we just touched on how short we are on inventory a moment ago. We are in our 6th month straight of having less than a full month of inventory. We really only have about 3 weeks right now. The median home price across all of Denver hit $460. That's a 10% increase over last November. Now there's other data all in the news that the average home price in Denver has hit over 600. We're hitting 615, 620. Averages can be a little skewed because as more and more homes hit the 1 million plus mark, it pulls up the average. So your median tells you half are selling below, half are selling above. Now also, as we see more condos and townhomes selling, that is pulling the number down. So, we're somewhere between the median and the average, really. I see most homes are going somewhere in that $500,000 range. Here's a key truth. Homes are selling at near full price. 99.7% of asking price is the average. In reality, if the home looks good, you're offering well over list price to even get your foot in the door. And just since May, median home prices have increased 8%, which equates to about a $40,000 bump in home prices here. So what does this mean for you? Well, if you're ready to home shop in a market like this, shoot, I hear Boise is even crazier. Talk with your agent. Ask what a good offer is going to look like for you, for the price point you're in, for what you're looking for. Make sure you're able to compete in that market. And then any home that you love and you're writing an offer on, make sure you have put your absolute best foot forward anytime you write an offer. Don't hold anything back. Hey, it was so great to be with you, and I look forward to seeing y'all next week.